TMI Environmental Solutions, ticker TOMZ, beat consensus across the board. Q2 EPS came in at a loss of 5 cents, easily beating the estimated 11-cent loss. Revenue hit $2.25 million, soaring past the $1.84 million consensus. And management reaffirmed full-year 2026 revenue guidance of at least $12 million.
Right, but despite that dual beat, the stock dropped 6.42% on heavy volume, like 23 times the daily average, closing at 1.75.
Which is just a brutal market reaction to what looks, on paper, like a stellar quarter.
Yeah.
So if you're holding the stock or just watching from the sidelines, you're probably asking why. Today's deep dive takes our stack of Q2 earnings data, analyst notes, and management commentary to figure out exactly why a company growing top-line revenue by 118% year-over-year is getting punished.
Yeah, we really need to unpack the hidden mechanisms driving their sales and, well, the glaring traps lurking in their balance sheet. To truly understand what's happening, you have to look at how the revenue is actually being generated. I mean, product revenue surged 185% to $1.86 million.
Right. But the hidden mechanism there is the shift in their product mix, isn't it? It's that classic razor and blade model.
Exactly. They sell SteraMist decontamination equipment. That's the heavy hardware, the razor. But the real story is the proprietary applicators you need to actually use the equipment.
The blades.
Right, the blades. Applicator sales skyrocketed from just $13,000 a year ago to $355,000 this quarter. Service revenue, on the other hand, was mostly flat at like 3% growth.
Which completely explains how they expanded their gross margins. They went from 50.3% in Q1 up to a very healthy 61.7% now.
Yeah, because once a customer buys the SteraMist hardware, they are locked into buying those specific high-margin consumable applicators over and over again. It's a compounding revenue stream.
And combine that high-margin mix with management successfully cutting operating expenses by 10%, which narrowed the operating loss by 78%, bringing it down to just $244,000.
Right, the operational execution looks highly efficient.
Okay, wait, I have to push back here, though. Because if management expects to hit cash break-even by Q4, and they're boasting a $35 million pipeline. Plus, they just secured an EPA label expansion for Agrimist in the cannabis sector.
Right, which is huge.
Exactly. So what is Wall Street so worried about? Why the 6% sell-off?
Well, because right now, TOMI is like a high-performance sports car with a roaring engine, but it's running on absolute fumes right before a cross-country race. The anxiety driving that sell-off is entirely hidden in the balance sheet. Their cash position is severely constrained at just $322,000.
Oh, wow. A $35 million pipeline sounds incredible, but with only $322,000 in the bank, how do they even finance the raw materials to build and fulfill those incoming orders?
That is the exact question institutional investors are asking, and it gets more complicated. They have a planned merger with Carbonium Core, which requires a massive $10 million concurrent financing to close.
A $10 million capital raise requirement for a microcap with $300,000 in the bank is definitely a red flag for you as an investor.
Precisely. The market isn't reacting to the past quarter. It's pricing in the very immediate dilution risks. Because they're so cash-strapped, they've been leaning heavily on an equity line of credit. They also recently amended their convertible notes.
Right, they lowered the conversion price to $1.50. By doing that, they're essentially forced to print more new shares to satisfy that debt. Every time they do that, it dilutes the value of the shares you might already own.
Exactly. Your slice of the pie gets smaller. They even had to execute a 1-for-3 reverse stock split recently, purely to maintain NASDAQ compliance, its financial triage. And on top of that dilution, you have severe concentration risks. Just 2 vendors make up 77% of their cost of sales.
Wait, really? Just 2 vendors?
Yeah, and 2 customers represent 33% of their revenue. If even one of those relationships falters, the whole supply chain buckles.
So it's a classic race against the balance sheet. The sales momentum is undeniably impressive, but they are sprinting toward a financial cliff.
Yeah. It makes you wonder about the long game. I mean, TOMI's operational turnaround is real. Their $2.6 million backlog is impressive, but you have to watch if their sales momentum can outrun their immediate need for capital.
And if they can't fund this $10 million pivot, are they setting themselves up to be a prime distressed acquisition target? I mean, one of those 2 massive vendors who already control 77% of their supply chain could easily step in and buy that roaring engine for pennies on the dollar.
Now that is a scenario worth watching closely.
Definitely something to monitor. Well, that wraps up this deep dive. Don't forget to follow the show for daily earnings coverage.